opinions expressed by the program participants are their own and do not reflect those of Blue Line Futures LLC or their affiliates. The content is for informational purposes only and should not be taken as trading advice. Futures trading involves a substantial risk of loss and may not be suitable for all investors. Therefore, carefully consider whether such trading is suitable for your financial condition.
Hi, everybody. Welcome to episode 26 of the Macro Corner podcast, proudly presented by Blue Line Futures. I am your host, Paul Wankmuller. My co-host is Giannis Mindall. Welcome to the show, Giannis.
Hey, Paul. It's a pleasure to be back on the podcast after a week off, and looking forward to have all the listeners join in again.
Absolutely. We're going to dive into something a little bit different today. What are the economic conditions needed for growth? And this goes into a couple different things. We are seeing a possible shift in the mindset of the Chinese economy. We have seen that they are coming out of the COVID lockdowns. There were some protests over the past 2 weeks. But most importantly, what are the capital inputs? What are the labor inputs and the role of technology to really start and dive down into what's going to produce anything?
Yeah, so we talked a lot about economic growth and inflation in general. I mean, every week almost, the market does pay attention to those things. But one of the things we don't nearly talk about as often as we should is really the inputs that go into these two factors. And today we will specifically talk about the inputs to economic growth. So when we zoom out and we ask ourselves, what are really the drivers? We have, on the one hand, we have capital, so things like manufacturing hubs. And then on the other hand, you have labor as an input. So how much population can you put into the economy, and that population is producing an output. And then you have, on top of those two factors, you have technology layered over capital and labor. So the economic phenomenon that we basically saw pre-COVID and really after the great financial crisis was extremely low volatility of not only inflation, but also economic growth. Because what happened was you had low productivity gains, but you still had the benefits ongoing from the labor arbitrage that came from China. You still had consumption, not great, but basically humming along, and that gave financial assets and therefore investors a lot of visibility into the future. We all know that uncertainty is the thing that financial assets hate, and we basically had the diametrical opposite economic circumstance to uncertainty. We had extremely high visibility, we had extremely low volatility of economic growth, and all of that was related to some of the factors that are maybe waning a bit as we speak.
And don't forget liquidity as well.
Exactly. And it was inflation. It was extremely low inflation for a really long time that allowed liquidity conditions to be as favorable as they were back then. But yeah, let's dive into productivity, I'd say, and some of the developments that are unfolding there.
Sure. So productivity, clearly there's a direct correlation between technology and productivity. I mean, we'll look at, the Henry Ford scenario with the assembly line, et cetera, things like that. And, with regards to factories now, if there is a little bit of an issue in China, it's not so easy just to be able to say, hey, I will just move my factory to a different country. And, what does that scenario look like?
Yes. So one of the things that came about with the acceleration of globalization was really the mindset that both capital and labor driving global economic growth are really mobile, and you can shift capital and labor, those two production factors, from one country to the next as you wish. One of the things that we do not consider simplistic assumption is the size and scale with which China is producing goods for the rest of the world. And there has been an increasing reliance on China as a result. One of the really interesting things going on underneath the hood right now, though, is that the CCP is basically shifting away from a growth at all cost agenda to a point where they want to transition the Chinese economy away from a state subsidized manufacturing hub to more of a consumption economy. What
Right.
does that mean? Wages will ultimately want to be higher if the CCP wants to accomplish that, and maybe some of those benefits that the rest of the world has benefited from are not there anymore. And as a result, we need to see productivity gains in the West. And mind you that some of these production factors in China, that has been a lot of unproductive growth. And the Chinese are paying the price for that right now. What we see is that the real estate bubble is basically imploding over there, although Chinese corporate bonds of those real estate developers are about 2x off the lows. But overall, in the grand scheme of things, when the Chinese consumed 50% of the world's copper, a lot of that copper went into real estate projects,
Right.
into ghost cities, into infrastructure projects that didn't lead to any productive growth, and they're shifting away from that. So as they're seeing that their own growth was unproductive, the West needs to step up its game and again focus on productive growth. But these are long lead time processes. These are long lead time changes in the economic fabric, and the world has to deal with that in order to set the conditions for tomorrow's, by which I mean the economic growth conditions
Right.
in a couple of years from now.
Right. And I mean, it's ebbs and flows, right? It's there. It could be even called a reversion back to the mean. But of course, like you said, we really don't want to say that these companies were addicted to the cheap capital. But in the same respect, if it only cost you 1% to borrow capital and you were able to produce 4% and you got away with it for a long time, that's just not the scenario anymore. So we're coming back to revert back to the mean.
Yes, exactly. So one of the things that we need to consider as it pertains monetary policy more broadly is that over the course of really the easy monetary policy regime, a lot of companies have grown really complacent and they have loaded up on a lot of debt. And as you alluded to, when you have a capital project, say you are the Ford Motor Company, and you have a capital project that you can invest in, and that capital project, let's say, has a 4% rate of return. So if you
Right.
have a cost of capital that and the interest on that capital costs you about 1%, that project looks like a pretty attractive project. And you might put in a couple $1 billion, and all of a sudden, as the economic fabric changes, though, as the cost of capital goes up, as the Fed returns the price signal to the economy that we may wanted to have some time ago in order to avoid the complacency that came about with avoiding price signals, suddenly that project doesn't really look as attractive anymore when we're talking about a 4% Fed funds rate. So it's
Right.
really the complacency that came about with monetary policy being as easy as it's been for a really long time. And it will basically be a regime shift that takes a long time. We had a podcast episode in the past that was titled Regime Shift. We
Mhm.
saw that this year corporate defaults were still extremely low. Moody's estimates that those corporate defaults on a high yield end will ultimately go up next year as some of these debt maturities come due. But yeah, these are long projects and long processes rather. And one of the things I just want to make clear is we're talking about capital, meaning money that's getting
Yes.
borrowed, and then capital in the sense of economic growth. In particular, that's referring to the capital as a factor of production, which would mean manufacturing hubs that come about because you have capital as in money provide you with the ability to build those manufacturing plants. But yeah, I mean, one of the last factors that we may want to touch on is the lack of structural reform and the lack of supply side economics that we have seen.
Right. And what do you mean by structural reform? Is that something that maybe we're seeing a shift in China due to the protests coming out about 2 weeks ago?
Yeah, I mean, this is ultimately a larger phenomenon, but of
Mhm.
course, protests like the ones we have seen do play a role in that. I mean, one of the things to be aware of is that China structurally is probably shifting to a lower growth regime, but globally, as the landscape for politics writ large has changed a little bit, structural reforms, as in trade pacts,
Okay.
changes in regulation for different product markets, things like that basically enable the economy to function a little bit better and
Okay.
therefore produce more economic growth. Those structural reforms have stalled over the years. And we saw a lot of those in the late 1980s, and that brought about economic potential and economic growth in the later stages of the century, and then also in the early 2000s. But those effects have waned, and if we don't start doing supply side economics, which by the way, Jay Powell at the Brookings Institution on Wednesday, he
Yeah.
called specifically for supply side policies because the Fed can only impact the demand side.
Right.
The Fed does not set the way that the country produces its goods or services, yet they need to control those factors by crushing or enhancing demand. So Jay Powell knows that he cannot change the economic fabric. And in order to do that, we will need structural reforms. Unfortunately, those have not been politically popular, and therefore we have seen a lack of those structural reforms. But let's see. I mean, it's going to be a question of time. And as inflation perhaps stays a little bit elevated, those structural reforms will again become popular in the process and therefore change some of the underlying dynamics with which economic growth comes about.
Well, one thing that we have seen and we talk about on the show is how the pace of things speed up over time, and maybe something, the structural shift and the structural reform that maybe took a decade, 30, 40 years ago, with the advent of technology and the connectivity that we have around the world now that wasn't really existent then, maybe we'll see those changes happen a lot quicker.
Yeah, exactly. I mean, when we turn to productivity and whether technology has impacted productivity growth, we have not really seen that spill over into productivity and therefore a lack of economic growth. But yeah, I mean, there can always be a surprise. And of course, the assessment of how productivity and growth looks today does not mean it can't change in the future. But surely we can always see a surprise that can bring down inflation and therefore enhance the economic growth potential.
Looking forward to it. Giannis, always a pleasure doing the show with you. Again, that was episode 26, the Macro Corner podcast, proudly presented by Blue Line Futures. The Blue Line Futures chart book is available in the description of the podcast on BlueLineFutures.com, as well as attached to the email sent to clients every Sunday. Not a client? Reach out to podcast@BlueLineFutures.com for a 2-week complimentary trial of our premium research covering equity indices, bonds, metals, grains, livestock, and so much more. Thanks again, Giannis. Thank you again to our listeners. We'll see you guys next week.
All opinions expressed by the program participants are their own and do not reflect those of Blue Line Futures LLC or their affiliates. The content is for informational purposes only and should not be taken as trading advice. Futures trading involves a substantial risk of loss and may not be suitable for all investors. Therefore, carefully consider whether such trading is suitable for your financial condition.